All right. So our link should work now. I was online with McGraw-Hill, and we got it. I don't. Something was just. They don't know what it was, but. There you go. So easy. I mean, not that it. You could always, anytime you click on one of the assignments, you always have the option to go to the ebook, I guess, in there. So, you know, but just if you a little ease for you. Okay. Any questions before we get into it? No? Okay. What I want to do is real quick go over, because since the video also ended, so if you wanted to watch it again, I did delete a bunch of information from my phone. So now I have about 100 books on Audible, and they're all downloaded. So I'm like, okay, well, I don't need them all downloaded, obviously. So we're gonna go back and start. Maybe. Hey, cool. Kind of just do a real quick refresher on the rate structures here. So remember, we've got the 3 rate structures for different types of taxes. We're not talking just about income tax. We're talking about all different types of taxes. Of course, we're going to focus on income tax in this class, as skip recognize. But these different types of rate structures could apply to any different type of tax. So our progressive rate structure, remember, we have two factors that determine any type of tax liability. We've got our tax base, right? So this is whatever it is that's going to be subject to the tax. So as I described it on last Thursday, this in our case is income. What is our tax base? What amount of income is going to be subject to tax? But this could be, if we're talking about property tax, then we're going to talk about the value of the property. That's the tax base. If we're talking about sales tax, we're talking about the amount of the sale that occurred, right? So tax base times our tax rate is going to equal our tax liability, right? So if we have a $10,000 tax base and our tax rate is 5%, our tax liability is going to be what, $500. Okay, and that holds true for any type of tax. Now, when we are talking about a progressive rate structure, we're going to start with our tax base. As our tax, let me put this down. So as our tax base increases, our tax rate is also going to increase, right? Which is going to naturally lead to an increase in our tax liability as that rate increases. When we're talking about proportional, as our tax rate increases, our tax rate is going to remain constant. It's not going to change. So if our tax base here was 10,000 and it's at 5%, if it's 100,000, it's still at 5%. Right? It's not going to change as we go up. And the example of our proportional tax rate was sales tax. If your purchase is subject to, if it's within this tax base, it doesn't matter whether it's $1 or $100,000, that rate is going to remain the same, right? As for a regressive tax rate system, as our tax base increases, our tax rate goes down. The example of this is Social Security tax. Because as you recall in payroll tax, and I know a couple of you haven't completed payroll tax yet, but so you're getting a little preview here. With the Social Security tax, we have a Social Security wage base. So once we reach a certain wage amount, any additional income that is earned is not subject to Social Security tax anymore. And that rate is roughly $160,000, something like that. Okay? So this pretty much summarizes the difference between those. Our income tax structure, our federal income tax structure is progressive. You can think of it in terms of the more you make, the more they take, right? So, and there are arguments for and against each of these types of rate structures. There are arguments with regard to fairness and legitimate arguments that can be made for any of the, well, maybe not the regressive, that's probably not, I'm not gonna get a fairness one, but for the proportional versus the progressive. But currently, this is what we look at. And so those marginal tax brackets, this is what you're seeing. That tax base is going up, and then that tax rate is going up. But again, it's only on, with regard to our marginal rates, it's not on the entire amount of the tax base. It's on the additional amount that's being added to that tax base. Okay? And this is, so here's our illustration here. Any questions about those three different rate structures?
I have a question.
Yeah.
I tried to click on that link and it's still just like sitting here loading.
Which link?
The one that you said that was fixed now. I see everybody else made it, but like mine is just like loading.
Maybe exit and go back in.
Yeah, I can try that again.
Yeah, or if you can't get in that way, I don't know why, but you can always just go right directly into Connect
Okay.
as well and get to the ebook, or click on one of the other links and get to the ebook as well. Anybody else having problems with getting in? No? I don't know, or I don't know why it would be the computer, but
Yeah.
that's always an option too, is to pick another computer. Okay, so we are spending most of our time in this class, well, pretty much all of our time in this class, talking about this rate structure, this progressive rate structure. And as I had mentioned, Iowa currently has this type of rate structure as well, but we are moving to this, where there's going to be one, and we're only talking about income taxes, again. That's it, we're not talking about any other types of taxes, but Iowa is moving to this proportional or flat tax type of rate structure. Any other questions? No, okay. Make sense? Sorta? All right, cool. I can't reach up there, so